Joining us now in a CNBC exclusive interview is Coca-Cola's chairman and CEO, James Quincey. Good to see you, James. Thanks for joining us.
Good morning. Nice to be here.
So you saw the strong pricing, which everyone expected, and we're seeing across these consumer names, but also volumes came in higher as well, which may be a bit of a surprise. What did you see during the quarter that drove it?
Yeah, we had good balanced growth. We had the pricing, and we had volume. Volumes were very robust. Latin America, emerging markets like India. Actually, consumer was still resilient in Western Europe and growing. Even here in the U.S., we were able to balance out affordability and premiumization and get a pretty strong result. So there is still a lot of global growth out there that allowed us to continue to bring people into the franchise. And frankly, it's growth that we've earned with our marketing, our innovation, and our commercial strategies.
Pricing, though, is strong, double digits. We saw this from P&G on Friday. How sustainable is that, especially in a world where we are seeing disinflation?
We are seeing some disinflation. Some materials have come down, but COGS that are very important to us, like sweeteners and juices, are still substantially ahead of prior year. Overall, we see moderation. We see the input costs moderating as we go through the year, wages moderating as we go through the year, the kind of cost of media moderating, and in tandem, we'll see our own pricing moderating as we both cycle last year's strong price increases and the marketplace, particularly in some of the developed economies, starts to go back to less off-cycle price increases. So I think we're going to see, if the central banks deliver on the environment of a moderation or a soft landing, then I think we are going to see both come down in tandem through the year.
And it will go into your portfolio, because some are wondering, food and beverage inflation has been so stubbornly high, whether the companies like yours, but everyone, are keeping prices high in the face of falling costs to preserve profit margins and profitability in this environment.
We're very much focused. I mean, COGS are still going. Let's start on the basics. Costs are still going up for us. Costs this year, taken all together, we expect to increase by mid-single digits compared to last year. So there still is a residual follow-through of higher elevated increases in costs compared to pre-pandemic times. We're very focused on earning the ability with our consumers to take those price increases to move those costs through. But our strategy has been very much about passing the costs through appropriately rather than anything else, and to continue to try and keep our consumers in our franchise. We're not in favor of trying to do big, violent movements one way or the other.
You just mentioned the term soft landing. So does that mean, James, you're not seeing real concerns that you would typically see around consumers going into recession, say in the U.S.?
I mean, there are pockets of consumers in the U.S., in Europe, that are clearly under pressure in terms of their purchasing power and starting to exhibit buying patterns typical of kind of the early recessionary phases, whether that be trading down to private label or putting off the purchases of large ticket items. Having said that, there are other people who've got the purchasing power or who are deciding to spend, and so aggregate demand is there. I mean, it's one of those things where we've been talking for at least 3 quarters about a landing that's 2 quarters away, and here we are still expecting it 2 quarters away. So yes, we're planning on a moderation towards the end of the year, a soft landing, if you like, but it's been predicted a few times already. So we'll see how it plays out.